Imagine opening your banking app after paying all your bills, and for once there's actually money left in the account. Sounds unrealistic, right? But let's say it happens. Now you're facing a decision that could quietly shape your financial future. Do you use that extra money to aggressively wipe out your debt? Or do you invest it and let compound growth build wealth over time? At first glance, this might seem like a small decision, but over decades, that choice could mean the difference between retiring comfortably or spending your later years constantly worried about money. We're not talking about a minor difference either. The gap between these two paths could easily reach hundreds of thousands of dollars. In some cases, it could even cross the $1 million mark. The problem is that most people make this decision based on emotion rather than logic. They follow their gut instead of understanding the math behind the choice. And that's exactly what leads many people down the wrong financial path. So today, let's break this down in a simple way so you can make smarter decisions with your money. Before we get too deep into the numbers, let's clarify something important. This discussion isn't about obvious situations like high-interest credit card debt from impulse shopping or overspending. If you're carrying extremely expensive debt, the answer is usually clear: eliminate it as quickly as possible. What we're talking about here is the more strategic question, the kind of decision that separates people who slowly build wealth from those who spend their entire lives paying interest. Here's a concept that surprises many people. When you pay off debt, you're essentially earning a guaranteed return equal to the interest rate on that debt. For example, imagine you have a credit card charging 22% interest. If you pay off that balance, you've effectively earned a risk-free 22% return on your money. Try finding an investment that guarantees that kind of return. It's nearly impossible. Now let's compare that to investing. Historically, the stock market has averaged about 10% annual returns over very long periods. But notice two important words there: historically and long periods. Markets don't move in straight lines. Some years your investments might grow 30%. Other years they might drop dramatically. That unpredictability is the price investors pay for long-term growth. So this raises a simple question. If your debt costs 5% interest, but investments might earn around 10% over time, wouldn't investing make more sense? On paper, the math seems obvious: a guaranteed 5% cost versus a potential 10% gain. But real life is rarely that simple. Risk changes everything. When you eliminate debt, the return is guaranteed. No market crash can erase the interest you're no longer paying. There's also something powerful about the psychological relief that comes with having fewer financial obligations. Less debt means fewer monthly payments and fewer things keeping you awake at night. Investing, however, is a different experience. Sometimes it feels amazing when your portfolio grows quickly. Other times it tests your patience when markets drop and your balance shrinks. The rewards can be huge, but so can the uncertainty. Let's look at a practical example. Imagine someone has a $350,000 mortgage at a 4% interest rate over 30 years. Their monthly payment is about $1,670. Now imagine they also have an extra $1,000 each month that they could use to pay down the mortgage faster or invest. If they apply that extra $1,000 toward the mortgage, something interesting happens. Instead of taking 30 years to finish the loan, they could pay it off in roughly 14 to 15 years. That's cutting the loan timeline almost in half. They would also avoid paying around $140,000 in interest over the life of the loan. That sounds fantastic. But let's consider the alternative. What if they simply paid the normal mortgage payment and invested the extra $1,000 every month instead? Over 30 years, assuming an average market return of around 10%, that investment account could grow to about $2.2 million. Yes, they would still pay roughly $250,000 in mortgage interest during those 30 years, but even after accounting for that cost, they could still end up with roughly $1.9 million in wealth. That's about $800,000 more than the earlier strategy, and that's a massive difference. But before you rush off and invest every spare dollar, remember that this example relies on several assumptions. It assumes markets perform near their long-term average. It assumes you stay invested for decades without panic selling. And it assumes life doesn't throw major financial surprises your way. Reality doesn't always cooperate with our plans. Another factor many people overlook is inflation. When you have fixed-rate debt, like most mortgages, inflation actually works in your favor. Your monthly payment stays the same for decades, but the value of money changes over time. That payment might feel large today, but in 20 years it could feel much smaller, simply because prices and incomes tend to rise over time. You're essentially repaying the loan with future dollars that are worth less than today's dollars. Meanwhile, investments like stocks and real estate often rise with inflation. That combination can work strongly in your favor. Of course, not all debt is equal. High-interest debt, like credit cards, is usually the first priority. Interest rates of 18, 22, or even higher are incredibly difficult to outperform consistently with investments. That's why many financial experts recommend the debt avalanche strategy, focusing first on the debts with the highest interest rates. By eliminating the most expensive debt first, you minimize the total interest you'll pay over time. Other debts fall somewhere in the middle. Student loans, for example, often carry moderate interest rates. Car loans are another interesting case. Unlike houses, cars are depreciating assets. Their value typically drops every year. So paying off a car faster might feel good psychologically, but financially it's not always the most efficient move. Your stage of life also matters. A 25-year-old investor has decades ahead to recover from market downturns. Someone approaching retirement has a much shorter timeline and may prefer the security of eliminating debt. Personality matters too. Some people simply hate debt and sleep better when they know they own nothing. Others are comfortable using low-interest debt as a financial tool while investing their money elsewhere. Neither mindset is inherently wrong. The key is choosing a strategy you can stick with. Another often overlooked piece of this puzzle is the emergency fund. Before aggressively paying off debt or investing heavily, it's crucial to have cash set aside for unexpected expenses. 3 to 6 months of living expenses in savings may not earn much interest, but it protects you from financial disasters. Without that cushion, one emergency could force you to sell investments at the worst possible time or take on even more debt. Taxes also play a role. Some debts, like mortgages, may offer tax deductions, and investments held for long periods may benefit from lower capital gains taxes. Even more powerful are tax-advantaged accounts, like retirement plans. If your employer offers a retirement match, contributing enough to receive the full match is essentially free money. Turning that down would be like refusing part of your paycheck. Finally, there's the human side of money. Financial plans look perfect on spreadsheets, but they only work if you follow them consistently. Switching strategies every market fluctuates is one of the biggest mistakes people make. Consistency usually matters more than perfection. So what's the real answer? Should you pay off debt or invest? The truth is that there isn't one universal solution. High-interest debt should usually be eliminated quickly. Lower-interest debt might coexist with long-term investing, and sometimes the smartest approach is simply doing both at the same time. But the most important step isn't choosing the perfect strategy, it's taking action. Because the worst financial decision of all is spending years thinking about what to do while doing nothing at all.